We're here with this week's mortgage market update here in your VA community. And today is May 30th, 2023. And I am joined with a guest this week. Today's guest is Jeff Wyttenbach. Did I get it right? Or I didn't practice that ahead of time. So
No,
how do
pretty
you say
close.
it?
Wyttenbach,
All right.
yeah. Awesome. Yeah.
So Jeff, do us a favor. Go ahead and tell everybody a little bit about yourself.
Yeah. First of all, thanks for having me. Jeff Wyttenbach, retired Navy, retired in October 21, did 20 years as a CB in Ventura, California, Port Hueneme area. Been a licensed mortgage professional now for about almost 2 years now, and then been a part of this awesome group called Vetted VA for about a year officially. So I've been launched on with you guys for about 2 years and been on the pros page for about 6 months now. So
fantastic. Well, thank you for joining us. Remember, everybody, if you're here live, do us a favor, go ahead and tell us that you're here. Say hello. I know we've got some professionals that may be jumping on. If you're a professional, tell us whether you're a VA real estate professional or a VA mortgage professional. If you're a consumer, that's of course, why we do this each week is to serve you in the VA consumer community. Those of you that are out there either thinking of buying homes or possibly refinancing or in the process. So we do this for you each week to try to give you some insight into what's going on. If you're watching on the replay, don't forget to give us a hashtag replay. Let us know that you were here. I know that many of you can't make it live, but we do love to know that you are watching on the replay. And with that said, let's go ahead and jump right in. We'll start out with a quick recap. Let's talk about where rates have been and all that good stuff. So remember, whenever we talk about rates, it's not an offer to lend. And when we talk rates, we're talking about averages and generalities. Your unique situation and your interest rates, they're going to depend on your particular situation. And as always, we encourage you to go ahead and shop your rates. So basically, if we do a quick recap, what happened last week, rates started to move higher through the end of the week. After last week's show on Wednesday, Thursday and Friday last week, not so good for mortgage rates. They did start to move higher as we figured they were going to do. However, after Memorial Day weekend, markets are closed on Monday, so mortgage rates didn't move. But Tuesday and today, we have seen rates improve a little bit. And basically, everything that we lost the end of last week, we kind of recovered. So rates are very close to where they were about a week ago now. We got some inflation data that came in at the end of the week last week, what we call the PCE inflation data, one of a couple different consumer inflation reports. PCE stands for personal consumption expenditures. That one happens to be the favored inflation gauge of the Fed, and we'll talk about that today. But the PC inflation data came in a little bit higher than expected, showing inflation still a problem, still a big deal. And as those of you that watch regularly know, different Fed members have been saying that they want to continue to raise that Fed funds rate until they can really get a handle on inflation. So that continues to be a bit of a problem. If you're out there shopping rates and you find rates in the mid to high sixes for a VA rate, that's very much in the realm of what's realistic. If you're offered something in the fours, I'd question that, or in the fives even, but if you're offered something in the sixes, that's very much in the right range. Conventional rates are in the high sixes to the sevens. If for any reason you're not using a VA mortgage to buy a home or to refinance, you can find conventional rates. What do you think, Jeff? What about you? You're in the field, you're talking to people. What have you found as far as quoting rates? Is that kind of in the mark, or am I off there?
No, exactly what you said. Last week or so, kind of creeped up. Mid sixes is, kind of the norm right now, for VA. So that's what I've been quoting. It does change a lot on, credit score pricing, all the variables.
Yeah.
But yeah, that's a very, very accurate rate.
Okay, awesome. So let's go ahead and talk about what's going to happen next and where things are kind of going from here and what we expect. So there's a lot this week that's going to ride on Friday's jobs data. So, we've seen rates improve a little bit to begin the week. Some people would say it's because of the resolution of the debt ceiling debate and the deal that was done about that. I tend to be a little more skeptical. I could go into the real deep reasons why, but I think basically when we see the end of the month, we usually see a lot of unique behavior around bonds anyway, because of the way that trading is done and certain requirements for traders to have assets in particular places, and that's done on a monthly basis. So usually towards the end of the month like this, we may see a little bit of improvement almost a little more of an exaggeration. But right now, if you guys looked at the fancy goofy charts that I like to show you, there's a shape here that I want you to see. And if we look at this, you can see it very clearly that each one of these candlesticks is an individual day. And as we go down, as we see these candles, as we see these lines move down, that's what drove mortgage rates up. And we've seen rates get worse all through the month of May. We've seen a very consistent, just downward trend to these mortgage-backed securities, which has led to mortgage rates creeping up. And just the last couple of days, we've had a very significant rebound. And one thing about these mortgage bonds, you'll notice, is they're cyclical. So what I mean by that is they will cycle down and then bounce up and then go down again and bounce up and go down and bounce up. So it's a matter of how far up are they going to go. And that's when you want to tend to make sure that you are locking in and protecting your interest rate. And as far as how far will rates improve from here, well, I don't have a crystal ball, but I can tell you based on our experience, there's a few things that are going to come into play. And the big one, like I said on here, is going to be that Friday jobs data. So right now, market's looking for, unfortunately, for the labor market to weaken. In order to see the economy slow down and see inflation slow down, we need to see people afraid of losing their jobs. It's an unfortunate way that the economy works. So if we get strong jobs data on Friday, we could see, rates actually be adversely affected. We could see mortgage rates creep higher on that news. But if it does come in a little bit weaker than expected, or shows signs of weakening compared to last month, then that could be something that helps us. And then over the next couple of weeks, if you're currently under contract and you're not yet locked in, again, always talk to your mortgage professional, because your unique situation is going to be, like I said, unique. But we've got 3 major events that are happening over the next couple of weeks that could really affect where mortgage rates go for June. The first one is that jobs data that's coming out on Friday that I talked about. The second one is the inflation data that comes out on the middle of the month on the 13th. That's our CPI inflation report. It's consumer inflation, and it's called the PCE is personal consumption expenditures. CPI is, I'm blanking on this one. But anyway, that one is a little bit different report, but same thing. We're looking for signs of inflation to go down. And then we have the Fed meeting on 6/14. And right now, there is a very big market expectation right now, almost 72%, that the Fed is going to raise the Fed funds rate for an 11th meeting in a row. We've had 10 rate increases by the Fed in a row. This was the meeting that just a month ago, markets said, hey, we're here. We can finally take a breath. The Fed should pause these interest rate hikes, possibly start looking at even cutting rates maybe in July or September. And now that's off the table because of strong economic data and everything that we've seen. We're now looking at the Fed, possibly raising this rate again. And as we get closer to that meeting, if that gets even stronger or more expectations that they'll raise rates after this meeting, that's going to hold mortgage rates higher. So we would really like to see the idea that the Fed may pause or circle back. So that's kind of what I have. Jeff, what about you? What have you seen, or any comments or questions on that?
Kind of more the same, right? So always the question is, should I lock my loan, right? So
Yeah.
if I'm under contract, should I lock, float? Like what you're just going over, the market is so volatile right now. So if you can afford it, you got your contract. My suggestion is lock your rate. Get that locked for 30
it's a good
days.
time.
It just lock it. I'm not here to criticize anybody or do anything, but nobody's smart enough to predict this stuff, right? So if you got a contract, lock your rate, get that locked in for 30 days, get your house, close your loan, and then, hopefully, you refi later in life. But
yeah, and we'll have a better idea as we get through June if rates are going to creep back down. What we would need to see is a weakening labor market, and that would come with Friday's jobs data. So specifically, less new jobs created, the unemployment number rising, and wages, coming down. Then on the inflation data, of course, we would need to see that that inflation number come down, which it has been doing. And there's actually two numbers in the inflation data. There's what we call the headline data, which is the all-encompassing data. And then there's the core data, which takes out energy and food costs. And the reason they do that is that energy and food costs can be especially volatile. And if gas were to jump up for the summer, that's going to be very inflationary, but it will come back down again in the fall generally. And that's why they say, okay, let's remove that. So we're looking specifically for that core data number to come down. And we've kind of stalled. So if that number does come down significantly, there's less of a incentive for the Fed to need to raise rates. And that's why that we're looking so hard at that number. And then that last thing that'll happen is the Fed meeting itself, and the Fed will either raise or pause their rate hikes or hike rates. And then the other thing is they're going to have what they call their policy statement, where they'll come out and they'll talk about why they have chosen the actions that they have. And that usually will get a lot of attention. And then after that, about a half an hour after that, they're going to have a press conference. And that press conference can cause a lot of volatility as well. So yeah, things can get crazy. Go ahead, Jeff. You've seen it.
Yeah, this contradict everything they just did. Makes those.
Yeah, it is. And what's funny is the markets react to it. So it's basically traders reacting to this news. So no matter how the news itself comes out, if the reaction is different than what you would expect, then all of a sudden rates go up or rates go down. It's very confusing to watch. And that's why I agree with you. Especially if you're under contract and you're close to closing, don't be afraid to lock in an interest rate. Trying to what we call catch a falling knife is very dangerous. Trying to time the market to get the best rate. There's certain times that we know a trend is in a direction where we say, hey, float because rates are on their way down and there's very little risk of seeing them jump. Then there's times like now where we say, we don't know what's going to happen. There's a lot of risk and rates could move higher. We could see rates move another 0.25% or even 0.5% if the data this month comes in, against us, if you will.
Yeah.
So, got some big thunderstorms coming. I can hear them over the mountain. So anyway, with all of that said, we talk about rates all the time, Jeff, and a lot of people may feel like, hey, rates, certainly seem higher. I'm going to wait for rates to come down before I buy a house. What would be your advice to somebody that was bringing that, that came with that attitude?
Oh, I love this question because I get it every day, right? So it's kind of being a real estate mortgage professional, get it all the day. When is the right time to buy? So I always say, if you're ready to plant your flag and you're going to buy your primary property, it doesn't matter on the interest rate, right? So I wouldn't say it doesn't matter, but if you can afford it, you can have your payment, you're pre-approved at whatever number that is, lock your rate, get in your house. So the power, the misconception of power of waiting, right? So the interest rates, if interest rates go down, more people in the market to buy a house, so that's going to raise the cost of the homes. But if you're planting your flag somewhere and you're ready to buy a house, I'll buy your house. That's always my recommendation. No matter what anybody says or does, but buy your house. If you can afford it, you can get in, buy your house.
If rates were to come down, do you think that that'll push home prices up or down?
Yeah, they're going to go up because it's just simple supply and demand. So more people say I'm just making up numbers here, at 500K at 5%, X amount of people are qualified. But if they're at 6%, now you're not qualified at 500K. Maybe you go down to 450. So that can break a lot of people at different price points in the market.
Yeah. And then, so what happens is if mortgage rates come down, there's more people that are able to get back into the market and look at buying, and that tends to drive demand. So we see more bidding wars. We see sellers don't have to give any kind of concession. In other words, they don't have to give any help towards closing costs or things that they may be more open to doing right now. And some markets, there's very tight markets and there's no room to wiggle. And prices are still going up in my market here in Western North Carolina. Jeff, where are you in the country?
Ventura, California, Ventura County, about an hour north of LA.
So what's funny too is we know that tight inventory is a big issue. And that's one of the things that's keeping home prices up. Normally, when rates would move up like we've seen, we would see home prices start to drop down a little bit more significantly. It's usually kind of a seesaw. As rates go up, prices come down. As rates go down, prices go up. And we have not seen that this cycle. And a lot of reason for that is inventory still remains tight. Is inventory tight in your market?
Yeah, absolutely. So, Ventura County is very anti-development. So we don't like to build a lot of houses, and it's kind of mountain range. So there really isn't places to build here. So we can't, there's nowhere to go. We got the ocean and we got the mountain range, and then we hit desert pretty quick. So there's really no place to build here to get more inventory. And as we all know, a lot of people are, I wouldn't say stuck, but a lot of people are in their houses at a nice, comfortable interest rate, of 3% or under. So they don't want to sell or upgrade or downgrade because they really can't or don't want to. So it's going to force a lot of people to stay where they're at right now.
It's funny because you're in California. One of the things that the federal government's trying to do, and they've tried this before and it didn't go through, but they're trying to pass a updated law to give a new number on how much somebody can walk away from the sale of their home before it's taxable. So with those capital gains, and because California, the home prices, of course, have gone up so high, we haven't seen that number change since in the 1990s. I think it might even have been 1997. And right now, you can be an individual and you can up to $250,000 of the home value you don't pay income tax on. Above that, you pay capital gains tax. And then 500,000 for a couple. So in an area like California, that's nothing. Somebody
Yeah,
that's a half a bedroom apartment.
no, for sure.
The bed's sticking out the front door. So they were looking at least doubling that number, making it $500,000 for an individual and $1 million for couples. I wonder if that would help inventory. More. That's their goal, is to get more inventory in the market. What do you think? You think something like that would help out at all?
I don't think so because I'm sure it'll help a little bit, but I don't think it's going to move the needle, like we think it is. So I
Yeah,
think just
I don't think
people,
that's the reason people aren't moving either.
for sure, it's just fifth grade math. So, you're in your house, you're comfortable, you have a 3% interest rate. You want to move up or down. And then you're looking at, doubling I wouldn't say doubling your payment, but going up 30 or 40% for a bigger or smaller house, and people just like aren't doing it. So I get these, I probably get a phone call every 3 days of crunching the numbers of, hey, if I sell my house and buy a new house, what am I looking at? And people, hang up very, very fast. So they're,
Yeah, it
now,
makes sense.
comfortable payment of, under 3,000, husband and wife work, your payment mortgage at 3,000, and, buy new property and they're at 6 or 5,900. And they're just like, no, it's like,
Yeah.
I'm not selling my house. Even if they sell it and make, a couple $100,000, it's just not worth it for them.
So, well, I noticed that some of you are on the VetaVA YouTube channel. If you have any comments, please feel free, type them in there. I'll keep an eye on them there. I see many of you on the VetaVA Facebook page. If you guys have any questions, let us know. If there's anything, again, it could even be your unique situation. If you'd like to ask a particular question about where rates are going or why they're moving or what you're looking for, feel free to ask. This is the forum for us. We'll give everybody a minute or so to do that. And if we don't see anything, we'll wrap it up. But Jeff, what about if somebody were to buy a home now and, 6 months from now, rates do drop significantly? Do they have any options?
No, absolutely. So especially with the VA, we talk VA a lot. Doing the IRL, the interest rate reduction loan, exactly what it says, right? Interest rate reduction loan, a 0.5% drop in rate, and then also the net tangible benefit. So basically, the math needs to work out to make sure you come down in payment with closing costs to make sure it makes sense. So normally, the rule of thumb is about a 0.5%. So if you get locked in at 6 or 6.5 or whatever they're at now, 210 days from your first payment, you can refi, and it's very, very easy to do. Even when I bought my first house, 8 years ago, interest rates started creeping down, started getting the flyers in the mail every day. Really thought it was a scam or fraud, but it really is this simple to do the IRL.
Yeah.
So
Yeah. So, and it's one of the great benefits of the VA program.
Sure.
It's one that you don't have with conventional financing or FHA financing is that, Earl. So, that's one of those things that you want to keep in mind. We can't guarantee you that rates will get better, but if they do, you've got options, and most likely you'll be able to qualify. Again, we can't guarantee you'll qualify, but most likely you'll qualify for an Earl, and you get the best of both worlds. You buy a home when prices are a little more stable. And then when rates get better, then your payment could go down because you get that. In the meantime, if somebody is looking to reduce payments, how do you feel about like a buy down scenario? I know different originators, different mortgage professionals have different opinions on them. What is your opinion on them?
Just the math things make sense, right? So this is where loan officer comes in. The rule of thumb is 36 months, kind of the buyback. So just do the math. Say, hey, I'm buying points for $5,000 to get a 0.25% or whatever that number is. Take that, whatever your savings is for the monthly payment to bring down that interest rate. Divide that by 36 months, and then see if that makes up the cost of paying the points of 5,000.
Right.
So
what about a temporary buy down? Have you, like, especially if somebody's able to get a seller concession where the seller is giving a credit towards closing costs, how do you feel about using that to help buy the payment down?
So if you get a seller concession and they help buying the interest rate down, absolutely, that's a win-win, right? And then to help out with closing costs as well. And then there's also, the 2-1 buy down or 1-1, buy downs. But with the 2-1 buy down, we just got to do the math to see if it makes sense. Right now, it's a seller market, so you may not get a 2-1 buy down, and they're expensive. So it kind of dictates your, your market.
Right. So I'll have to make a nice little graphic for this one, but a temporary buy down, for those of you watching, it's the reason they call it temporary is all you're really doing is paying interest up front. You're paying money up front, and then that money is put into an account, and it's actually used towards your mortgage payment. So imagine that if Jeff's going to buy a house and I say, okay, Jeff, I'm going to give you $10,000. And for the first year, your mortgage payment is going to be $1,000 a month cheaper. You're going to take that $10,000, well, $500 a month cheaper. And you're going to take that $10,000 and $500 a month we're going to take out of that account. So if your mortgage payment were $2,000, you only have to pay $1,500, and I'm going to take $500 out of this other account. And that's why it's temporary, because we're just using up that money. And that it only makes sense to prepay if that's coming from the seller. That's why when we talk about seller concessions, in certain markets, we do have homes that are sitting a little bit longer on the market. Sellers are more willing to negotiate, and your real estate professional can help you. Your mortgage professional can discuss with you what is a seller concession when the seller contributes towards your closing costs, and then you can use that money to basically buy your interest rate down for a year or 2 years. And again, it's only prepaying the interest versus if you do what's called a permanent buy down, or what we say with discount points, and a point again being 1% of the loan amount, that can bring your interest rate down over the life of the loan. The problem is if rates do drop significantly 6 months or a year from now and you refinance, you haven't recovered enough savings for that money that you've paid. That's where Jeff was saying about three years, 36 months as a rule of thumb. Jeff, do you want to explain that? Go ahead.
Yeah, just every deal's different. You got to bring it up and explain, the difference 2-1 buy down. Because it's so easy to do the Earl with the VA. I don't push the 2-1 buy down. Sometimes it makes sense. I'd rather have, get the seller concession, help with closing costs, and buy your permanent buy down, and then refinance you, and then do an Earl later if that's still there. So it's kind of like pick your poison. Do you want, 2-1 buy down to save, your interest rate for 2 years, but you still got to qualify for that amount, and then it does go up. So in 2 years, your interest rate, you're just putting a Band-Aid on the problem, I guess.
Right. And that might be good for some people that just want to take some of that payment shock off. Sometimes, you may be up for a raise, or you might be going to the next pay scale, and that money will, this just helps to kind of ease that transition, but you still got to qualify at the higher rate, which is good because, back when I used to write mortgages with dinosaur bones in my day, we would put people into loans that you could bring the payments down, and they were going to jump up later, like adjustable rates, and people couldn't qualify for those. And that was what led to problems. But, well, again, I didn't see any questions. Everybody, please don't forget to click that like button on Facebook or on YouTube. Otherwise, we are here for you each and every week. And we will be here next week. Of course, you can join us next week. We are here at 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. If you do have any questions, please go ahead and type them in either on the Facebook page or on the YouTube channel. We'll be sure to answer those for you. Otherwise, Jeff, thanks again for joining us, my friend. And anything you want to leave everybody with?
Nope. Buy your house. What is it? Buy your house, date the rate.
Yeah. Marry the house, date the rate. Yeah, that's it. So, but all right, everybody, you guys have a great week. We'll see you next week. Take care.
Appreciate it.